This conference will now be recorded.
All right, so today we're going to talk about property versus liability, and you got to know the difference. And it's part of the exam name. You know, the test you're taking is called the Property and Casualty Insurance Exam. Property is interchangeable with fire. So sometimes you'll hear fire and casualty or property and casualty. Fire and property are interchangeable, and for the exam, they are also. A property loss is the same as saying a fire loss. All right. And in casualty, it protects against a number of occurrences. Liability would be the biggest area of casualty coverage. All right. But also you got to consider workers' compensation as a type of casualty coverage. Right. Again, it protects against occurrences like a loss at work. All right. So keep that in mind as we go through this. You do want to know the difference again. Property and fire. Think of it your stuff, your belongings, your property. So you're the first party, you're the insured, you're buying a policy to protect yourself in case of a loss. So it's covering your stuff like your house, your car, your boat, your business, whatever it may be. And so in an insurance contract, the insured, the customer, which let's say you're buying a policy, you're the first party to a contract. The insurance company is a second party to a contract. So in a sense, insurance is a two-party contract. It's between you, the insured, and the insurance company, which is a second party. And so if you look up the definition of personal contract, it means it's a two-party contract between you and the insurance company. And it's pretty personal, it's just you two. Okay. That means anyone other than you two would be a third party. All right. And all liability claims are basically third party claims. All right. So if you damage, let's say you got into a collision claim, you're at fault, you hit another car. Okay. So they're going to come after you because that's liability. You injured someone else, damaged someone else's property. Okay. But there's also damage to your car because it was when you hit their car, it damaged your car. So that's a third party claim as a liability. The first party claim would be your collision coverage paying. Okay. So make sure you understand the difference. But again, whenever you see L for liability, think L for lawsuit. You injure someone else, you damage someone else's property, and they're going to sue you to pay for it. So liability covers their stuff or even them as individuals. That's the bodily injury piece. Their house, their car, their boat, their business, etc. All right. Now, there's no deductible for liability. I mean, if you hit someone and injure them, you're not going to pay them a two. I'm not. You're not going to charge them a 250 deductible before your insurance kicks in. Okay. And so here and there, you might hear it called first dollar coverage. It means there's no deductible, and your primary liability coverage, like your auto and your home, is a first dollar coverage. Now, for property, that's your stuff, right? There is a deductible. So a deductible is how much you have to pay before your insurance kicks in and covers the loss. The higher the deductible, the lower your premium. Because if you take care of more of the little stuff where the insurance company doesn't have to deal with small claims, then they give you a premium savings. And so by raising a deductible, it lowers your premium. Now, you typically have deductibles on real property, and anytime you see real property on on the test, think of structures. We're talking to buildings. That would be your house, your separate garage, maybe a commercial property, a building. Okay, and in personal property, we call contents coverage. All right. Again, if you flip the building upside down, anything that falls, all right, that would be personal property or contents coverage. All right. Think of if you were to move, what would you take with you? That would be personal property. I mean, even though you mounted a ceiling fan into the house, when you leave, you probably leave that behind. Okay. I mean, you could take it, but it would be some work to take it out. Okay. So personal property or contents is easily movable, easily removable. And that's what how you want to understand that. For
Okay, so
liability coverage, we got different areas. Question,
yeah,
Evan?
just one question.
Yep.
For the so for the real property, so that's the same as the other structure, or
Yeah, it would be the main house or other structures on the premises, like a gazebo, your pool, your separate garage. That would be other structures. That would be real property.
so like let's say on the dwelling, it's like dwelling and then other structures, so it's the same as real property, right?
Yes.
Oh, okay.
Okay, you got it. Because again, I mean, if you move, you're not going to take the fence with you.
Yeah,
You
you're
see,
right.
so that would be a structure, and we call that real property. Okay. Good, good, good. All right, so for liability coverage, there's different types. And so you want to understand some of this terminology, and it's terminology that you may use in the real world. Some of it you'll use, yeah, well, actually, in the liability side, definitely the workers' compensation side. So we'll start with absolute liability. This is the ability to compensate without regard to fault or negligence. I mean, that's the definition that you're probably going to see when you take your exam. The best example of absolute liability would be workers' compensation. If you're an employer and you hire an employee, you are absolutely liable for all losses associated with that employee if they're injured while engaging in activities for wage or profit. That's how your test defines it. But it's basically you hire someone and they're doing work for you. All right. They're doing something at your direction. If they're injured under workers' compensation, which is required by state law, you have to provide medical, income, death, and rehabilitation benefits for that employee. That means even if that employee did something stupid and got themselves injured, you're still liable. And so we're holding you, the employer, absolutely liable for all losses associated with your employees. That's how you need to understand that. Unless the employee is under the influence of alcohol or drugs or engaging in intentional acts, then it may be excluded. But for the most part, it's required to be covered. Okay. Now, strict liability is kind of close to that. But strict liability, think of manufacturing companies that manufacture products. So if you bought a toy from, let's say, one of your local department stores, and a year later it malfunctions and injures your child, you're not going to sue the department store you bought the toy from because they're just a distribution chain. You're going to go directly after the manufacturer of that defective product and sue them for the injury that that toy did to your child. Okay. And that's what strict liability is about, holding the manufacturer strictly or totally liable for all losses associated with their defective product. Okay. So again, workers' comp is absolute liability. Manufactured or products would be strict liability. Now, vicarious liability or vicarious liability, however you want to say it, okay, is where you are responsible for the actions of another. And as a parent, you are responsible for the actions of your children. So if your children grab some rocks and they throw them through your neighbor's windows, you're going to be held liable, all right, because you're responsible for the actions of your children. You're responsible for the actions of your pet. Okay. So in most states we have leash laws. So if your dog is not on a leash, it runs out and bites someone, you're liable. Okay. And that's where we're holding you liable. Another area where this comes into play is again in the job industry, the business environment, where as an employee you accidentally injure the customer. So as an employer, you're responsible for the actions of your employee. That's very vicarious liability. All right, that's where it comes into play. So you need to know that association. Types of losses under liability, first and foremost, bodily injury. I mean, it's pretty straightforward. Someone slips and falls, they break their arm, they break their hip, whatever in the fall. That's bodily injury. Physical injury to their person, right? Property damage would be damage to their property. Physical injury or damage to someone else's property. That's what property damage liability is about. It's not yours, it's other people. Okay. And so this is covering the other people, this is covering other people's property. Now, personal injury could extend from bodily injury or property damage. And personal injury, that would be the mental anguish, pain and suffering, where you backed out of your driveway. And when you backed out of your driveway, you hear a crunch. You stop the car, you get out, and you run behind your car, and you ran over your next door neighbor's kid's bike with your next door neighbor's kid on it. Okay. So not only did you damage the bike, you injured the child, and now the parents might come after you because now their fear of their child, they can't sleep at night. They're afraid that something might happen to their child, and so because they can't sleep, they can't work, they lose their job. That's the mental anguish that could be stemming from that situation. Okay, so it's not really bodily injury or property damage, but it can stem from it. Personal injury, a lot of times in today's environment, would be unfair discrimination, sexual harassment. Okay, so they're not physically injured, but mentally they're affected. And that's how you want to understand it. Employment practices liability is designed to cover things like that. All right. Types of paid loss. If the loss is very specific, we call that specific damages. And what that means is you could put a specific dollar amount to the amount of the loss. I mean, if you get into an accident or you get a ding in your fender, that's pretty specific. We know exactly what it would cost to fix the dent, including labor, or we know exactly what it would cost to replace the fender, including labor. And so it's very specific. We know the actual dollar amount pretty quickly on the value of that particular loss. Associated with specific damages, you might see special damages on your test. Whenever you see special damages, think of lost wages. So if you're injured because of an injury and you lost 8 days of work, well, we know how much you make a day times 8 days. You see, so that's special damages. It's part of specific because we kind of know what we're paying, but this is more for lost wages versus the actual damage. And so that's the difference. And so keep an eye out for that. Special damages, that would be replacing someone's income. Now, I'm not talking sales bonuses, right, that you might have gotten. That's not what we're talking about. It's actual lost wages or lost income because of this particular scenario. General damages are the non-specific, and that would be the mental anguish and pain and suffering. I mean, in some cases, you really can't put a dollar amount to that mental anguish where, you just saw your kid get run over by a car. Okay, you can't really put a dollar amount to that. And so a lot of times the courts will use a multiplier. Okay, maybe 3 to 5 times the specific damage awards, and that could be awarded for general damage. All right. Compensatory just means what the individual is being compensated for. So, and this would be, we're compensating you, and this could be a blend of specific and general damages. So this is just what's paid on a claim, right? So it's not its own separate limit. It's kind of what the total amount that's going to be paid. All right. Here and there on your test, you'll see punitive damage awards. Now, punitive damages are where they're imposing an additional financial, a fine. They're kind of setting an example for the industry to do something to keep this from happening again. And the best example I could probably use with that would be, there's a little old lady named Stella. She goes through a fast food restaurant drive-through, buys a hot coffee, and when they hand it through the window, she grabbed it by the top, and either the lid wasn't on properly or she didn't get a good grip, but it spilled out and dropped in her lap, giving her second and third degree burns in her lap. And so all she wanted was her medical bills to be covered. And the fast food establishment denied it, saying she didn't grab the cup, it's her fault. So she got an attorney, she sued, and all she sued for was medical damages. And surprisingly enough, she lost. So she got another high-profile attorney, got the press involved. They threw in $2 million or $3 million in punitive damages on top of her medical bills. And finally, the fast food establishment caved in and paid a settlement. So that $2 to $3 million punitive damage was basically a financial slap saying, you got to do something so this won't happen again. So what they did is they lowered the temperature of their coffee, so it's now lukewarm coffee, and they put placards, caution, our hot drinks are served very hot. And so they're giving, warnings to be careful with it in handling it. So, and that's what happened out of that. Okay, so that's punitive damages. It's to set an example, not just to that fast food establishment, but all the other fast food establishments that serve hot drinks. Okay.
So, Professor, like on the test, which is the best way that we can understand it? Like what should we put down? Because I'm writing it on the notes. I just want to remember the best definition for it.
Are you looking in the playbook? I think I have this in the playbook, right?
Oh yeah, right, yeah.
Yeah, you don't need to write it down. It's in there. So, yeah, but this would be kind of damage awards above and beyond the claim to set an example for the industry.
Okay.
Okay. And I got to be honest with you, that you want to use when you're having conversations with like business owners, if you're writing commercial insurance, if they had a claim in the past, you got to ask them, what steps have you taken to keep from this ever happening again? Okay. And if they haven't done anything, okay, then it can happen again, huh? But if they're taking steps to reduce it happening again, That's a good sell to the underwriter as to why, even though they had a prior loss, this is a good risk because they're responsible and they're making sure that this doesn't happen again. Okay. And that's where that comes in, like kind of that mindset. All right. So I threw a couple questions in here. So which of the following types of loss would result in a claim for monetary damages due to injury to another or damage to another's property? And I'm
Liability.
hoping you guys answered liability.
Yes.
Okay. Because if it's someone else, it's liability. All right. All of these, real property, physical loss, however yours, personal, this is your stuff. Okay. If it's someone else, that's liability. All right. So to show liability, we'll go into auto coverage. Now, on your test and in your studies, you might see personal auto policy in your studies. You might see PAP in your study. It's the same thing. And then you go take the test and they put under an ISO personal auto policy. And an ISO is Insurance Services Offices. And all of our companies get their policy forms from the ISO. So an ISO personal auto policy is the same as a personal auto policy. Right? So the reason I have to emphasize this is because you're studying this in your 52 hours, okay? And that's all you see is personal auto policy this, personal auto policy that, PAP this, PAP that. And then you go take the test and it says under an ISO PAP, and you're like, what the heck is that? You know, it's something unfamiliar. Think, oh my God, they must have had a new policy that my school didn't teach me about. And so now you're thinking that the question has changed. But realistically, this is thrown in there to kind of throw you off and making you think there's something else out there. And it has nothing to do with the question. Okay. So under a personal auto policy, liability covers who? You or them? Well, we just covered liability covers the other people. All right. So under an ISO PAP, liability covers who are you? Who does it cover? You or them? And again, it's liability. It covers them. You see, so this is irrelevant. All right. Another thing they throw at you on the test is unendorsed personal auto policy. So if you see unendorsed, it just means you bought a stock policy. You didn't buy any bells or whistles. You didn't buy any endorsements. And so you just bought the basic liability policy, which is liability, medical, uninsured motorist, and physical damage. That's kind of what that's about. Okay. So you didn't buy bells or whistles. There's no endorsements. Okay. So I want to emphasize that now so you're more aware of it when you go take the test. Otherwise, you go take the test and again, you're studying personal auto policy this, personal auto policy that, and then you go take the test and this is under an unendorsed PAP or unendorsed personal auto policy. You're like, what the hell is that? You know, because people stress out when they're seeing something that's unfamiliar to them when they're studying. And so it freaks them. And so I just want to give you a heads up. It's the same thing. So personal auto policy, PAP, ISO, PAP, unendorsed PAP, it's all the same thing. 4 ways of saying the same thing. So be wary of that. So under liability in most states, such as California, we have what's called split limits. Right? The minimum liability to register a vehicle in California is 15, 30, and 5. If you're in Florida, it's 10, 20, and 10. If you're in Alaska, it's 25, 50, and 10. So each state may have slightly different minimums. And that's irrelevant. You know why? The numbers still mean the same thing. This first number, 15, is 15,000. That's bodily injury per any one person. So you got into an accident, you hit someone in the car, and we're going to pay them up to 15,000 towards their medical bills. Okay, that's what this is basically about. Now, let's say you hit a car with multiple people. We're going to pay no more than 15,000 per any one person, but we won't pay more than 30,000 per all people in that other car that got injured in the accident you caused. So remember, if you caused it, you're liable to pay. So this is liability. We're paying the people in the other car, not you and your family in your car. All right. So the first 2 numbers cover the people per person and per occurrence. The third number covers the car that you hit. And it may not be a car. I mean, what if you hit a fire hydrant, a telephone pole? What if you lost control in the rain and drove through someone's living room? That's what this third number is. We're going to pay damage to their living room, in this case, 5,000. Probably isn't enough. All right, but that's how you want to know split limits: per person, per occurrence, and then the property damage liability is the third number. Now, some companies in some states allow you to do what's called a combined single limit, or a CSL. Okay, and all we're doing is we're taking the 30,000 in bodily injury liability plus the 5,000 in property damage liability, and we're just combining it to have a $35,000 limit. Okay, because in a total loss, the maximum this would pay in split limits is 30,000 for the occurrence and 5,000 for property damage, right? And so combined single limit is we just combine those and we just give you 35,000. Now this can all be applied towards bodily injury, it can all be applied towards property damage, or it could be blended. And that's all. So there's really no difference between split limit and combined single limit. So again, liability covers the people in the other car, medical covers you and your passengers in your car. Right. You can get like 1,000, 2,000, 5,000, 10,000. I've seen up to 100,000 can be added for medical payments. It's not a health insurance replacement, by the way. Okay. You want some medical, maybe to cover your deductible, and then your health insurance can take over from there. But another big thing about medical, it covers you and your family members if you're injured in and around the vehicle, and even as a pedestrian. All right. So if you accidentally slam your daughter's hand in the car door, you can actually file a claim under the medical payments portion because they got injured in and around the vehicle. All right. Uninsured motorist and underinsured motorist. This is where you got hit by someone who either doesn't have insurance, that's uninsured motorist, or they have insurance, they just don't have enough to cover your medical, and that would be underinsured motorist. Okay, so this is they don't have insurance, and this is they don't have enough to protect you. And so this is the liability coverage that actually pays you and your family because you got hit by someone else who either doesn't have insurance or doesn't have enough. Okay, and so that's kind of how that works out. Now, it only covers you and your family. It doesn't cover your car. So if you want to cover your car in case someone without insurance hits it, you need the uninsured motorist property damage. Okay. Aggregate limit. Good question, Steve. Okay. So this is a per occurrence. So in this particular case, we pay 30,000 per any one occurrence or accidents for bodily injury. Okay. So that's a per occurrence limit. An aggregate limit is the maximum we pay for all claims during a policy period. And so we'll say the aggregate limit will be 60,000 in this case. So you get no more than 30,000 per any one accident, but the aggregate limit would be 60,000. That means you basically can only suffer 2 full-size claims during this particular policy period. Once we paid 60,000, which is your policy's aggregate limit, then if you had another loss within that policy period, you'd have to pay out of pocket because you exhausted your policy limit. Okay. Good question, and you will get that on the test. Aggregate limit's a very common definition question that you'll get. Now, your commercial, all of your policies only have one aggregate limit. Your commercial general liability policy has 2 separate aggregate limits for the exam. In the real world, it has up to 6. Okay, and so there's an aggregate limit for premises and operations exposures, like a slip and fall in your building. And then you have a separate aggregate limit for products and completed operations for losses that occur away from the location of your building. So let's say you have a manufacturing plant, you manufacture toys and someone slips and falls. That's the premises and operations aggregate limit. But if they bought the toy and they went home and 2 years later it malfunctions, that loss occurred away from the location of your building. Therefore, that would be covered under the products and completed operations aggregate limit. Okay, so one's for on-site, the other one's off-site. And so it would have 2 separate aggregate limits. Okay, all right, cool. All right, now, so the UMPD, if you don't have collision, the maximum we'll pay for damage to your car is $3,500, right, because someone else without insurance hit it. But if you have collision, then we don't go with the 3,500, we go with the deductible waiver. So what's going to happen if someone without insurance hits you and you have collision coverage, right? You're going to use the collision part of your policy, but the insurance company will waive your deductible. So there's no out of pocket for that. Okay, and it'll be a no fault collision claim, so your rates won't go up on that either. Okay.
So, Professor, just
Yep.
for the UMPD. So
Yeah.
like what do you mean by if you don't have collision? Doesn't that mean like collision if like if somebody hit me?
Yeah. So let's say you have two cars. Okay. One, you have liability and physical damage coverage. Okay. So car A, you've got your liability coverages and you have your physical damage coverage. Fair enough. Okay.
Okay.
So car A, you would get the deductible waiver. Okay. For the UMPD, you'll get the deductible waiver. Now car B, all you have is liability only because the car is like 12 years old. All right. So you don't want to spend extra money on physical damage. So you just got liability coverages only. That means on car B, you're going to get the UMPD, which pays a maximum of $3,500. Okay. The difference between these two is either you have collision, you get the deductible waiver, or you don't have collision, then the maximum we pay is $3,500. Okay. So you can't
Oh,
have both of these on the same car. It just depends on the coverage on the car, which one you're going to get. Okay.
oh,
Fair enough?
yeah.
You got it. All right. So collision is colliding. It's actually, let me back this up. Collision is damage to your vehicle from colliding with a vehicle or object or upset. That means direct physical loss, damage, or destruction of a covered vehicle because of collision or upset. All right. That means, you caused it. It's your fault. All right. That means your rates are going to go up. Usually it's a higher deductible and your rates are going to go up. Now, upset is you hear stories of people driving down a long stretch of highway, they kind of fall asleep and they roll off the embankment. Their car flips over. That would be upset. That's a collision claim. Again, higher deductible, your rates are going to go up because it's your fault. Other than collision, which in the real world it's called comprehensive, but for the exam world they call it other than collision. And this is damage or loss, destruction of your vehicle from losses other than collision or upset. And so the most common other than collision claim would be windshield chip. Okay, something hit your windshield, put a pit in it, and then it teared, and then you got to replace the windshield. Okay, that's other than collision. Theft of a vehicle is other than collision. You get caught in a hailstorm, and hail's the size of grapes where it dings your car. Now it looks like a golf ball. That would be other than collision coverage. Now, if you hit an animal, we always say the animal hit you. So it's going to be an other than collision claim. Lower deductible, and since it's not your fault, your rates don't go up. All right, so keep that in mind. Again, theft. And your physical damage covers damage to the vehicle or any tools that are bolted or welded or used in relationship with that vehicle. So let me explain. A spare tire, the tire iron, your hood ornament, those are used for the vehicle. That would be covered here. If you have tools because you're a construction worker and someone broke into your trunk and stole them, that's not covered here because that's not used for the vehicle. It may be in the vehicle, but not used for the vehicle. That would be your commercial insurance covering your tools. Right? If you had a laptop in the back seat and someone broke the window and stole your laptop, the broken window would be other than collision claim. But the laptop they stole, that's actually personal property, which would be covered under your homeowner's policy. All right. Remember that your homeowner's policy covers personal property anywhere in the world. All right. But for your auto insurance, it only covers anything bolted, welded, nailed, attached to the vehicle, and tools associated with the vehicle. All right. So if it's installed in the dash, like maybe people get aftermarket radios and put in some speakers, that would be part of the vehicle because it's bolted, welded, nailed to the vehicle. All right. So that would be covered there. All right. So what would an insurer likely pay if the following were the details surrounding an accident for which the insured was at fault and had bodily injury policy limits of 25,000 per person and 50,000 per occurrence? So
So
three
let's
people were injured. Wait, hold
use
on. Let me finish this question. We'll get into it. Three people were injured. The first person suffered 11,000 medical bills. The second one suffered 26,000 medical bills. And the third person suffered 12,000 medical bills. And how you want to calculate this is a per person limit of 25,000. So we look at the first person and we pay the lesser of the two numbers. So 11 is less than 25, we pay 11. 26 is more than 25, we pay the lesser, we only pay 25 for the second one. 12 is less than 25, so we pay 12. So 11 plus 25 plus 12, that's how much we're going to pay. Okay. So they were underinsured, not by much, but it's enough to make a dent. Okay. And that's how you want to understand that. So go by the per person limit first, the lesser of the two numbers, and then you add them all up. And then you look at the per occurrence. And again, whichever is the lesser of these two numbers now is what the insurance company will pay. Okay. All right, Aben, let me go back. What was the question?
No, your screen is zoomed in. We can't see the questions.
Oh, is it?
Yeah,
Oh,
the next question that you did, I couldn't see that.
all right, let me try this again here.
Oh,
Yeah,
yeah.
that's as good as it gets. Is that better?
Yeah, that's good. Yeah.
Okay. All right. Good, good, good. All right. So that's the 48,000. All right. The liability section of your personal auto policy. Remember, the liability covers bodily injury and property damage to others. So you hit a car with a person in it. So bodily injury covers the person, property damage covers the car. And there may be prejudgment interest that could be paid also. Let's say you got hit by someone, they have insurance. You file a claim, and for some apparent reason, their insurance company denies the claim. All right. And so you hire an attorney and you take him to court and you win. All right. But this is like 4 months later, you win. That means they should have paid your claim today when you filed it. All right. And so prejudgment interest could be awarded you. So when you win the court case 4 months later, you could be awarded prejudgment interest, which is interest on the claim that they should have paid from the time that you filed the claim to the time that you won the court case. All right, that's what. And so prejudgment interest is covered under the liability portion of the policy. What a lot of people don't realize is when you buy liability coverage, you're not just buying the insurance limits that you saw in the previous example. You're actually also buying what's called supplementary payments. And this pays above and beyond your liability insurance. So if you had $100,000 of liability coverage and someone sues you because they're claiming you injured them and your insurance company chooses to defend you on this case, the defense cost comes out of the insurance company's pocket. It doesn't reduce your liability limit. If we need you to miss work to help us with the case, maybe take pictures of the location of the accident, make some poster boards so we can show to the jury. The expenses also can be reimbursed and lost wages up to a certain amount. Post-judgment interest. So remember, pre-judgment is liability, post-judgment is supplementary payment. So again, you file a claim, they deny it, you take them to court, you win. All right, prejudgment interest covers that. But now you win the case, but the insurance company drags their feet and they take 6 months to pay your claim. Well, that's post-judgment interest that can also be awarded you from the time you won the court case to the time the insurance company paid the claim. And that's going to be paid out of supplementary payments. If you need to get a bail bond, you pay for the bail bond. The insurance company will reimburse you up to a certain amount. And if they lose the case and they choose to appeal it, then you get the appeal bond and the insurance company will reimburse you, again, up to a certain amount. And so all of this pays above and beyond whatever limit you bought for liability. All right. So again, people don't realize you're not just buying the insurance, you're buying the insurance company's legal defense team to possibly defend you in a case against you. That's kind of cool. People don't, like I said, a lot of people don't get it. So knowing that, how that looks as an exam question would be this. All of the following expenses are covered in addition to the limits of liability under coverage A of a personal auto policy, except. So all of the following are in addition to liability, except. That means which is part of liability. And that's the prejudgment interest. All right, so the lost wages, right? Appeal bonds and bail bonds, this is all supplementary payments, right? Which is above and beyond the liability, but this is liability. So this is where it gets tricky because you get in addition to liability, except. That means which is part of liability. All right. You get some tricky one, like which of the following is not optional. If it's not optional, that means it's automatic. All right. And so a lot of this test isn't really the material. It's just getting through the verbiage they use and the nots and excepts to kind of trick you. All right. So now we'll go into homeowners coverage. All right. So section 1 is property. Coverage A covers the dwelling. That would be the house. Anything bolted, welded, nailed, attached to the house, that would be coverage A, dwelling. All right. Other structures, that would be the fence around the backyard. Could be a separate garage. You might have a gazebo or a pool or a shed in the backyard. That would be other structures. The standard limit is 10% of whatever you calculate for coverage A, which I'll show you that in a minute. If these two are the buildings called real property, right, then this would be your personal property, which is that easily removable stuff. Your personal property, like I said, is covered anywhere in the world. Right? The easy way is just flip your house upside down. Anything that falls would be personal property or contents. The standard limit would be 50% of whatever you calculate for coverage A. I'll get to that in just a sec. Now, if your house burns down where you can't stay there, you need a place to stay. Well, that's where loss of use comes in, where the insurance company can cover the cost to put you up in a hotel till they rebuild your house so you can move back in. Right? Now, that's section 1, property. Section 2 is liability, and liability on your home policy covers you anywhere in the world except 2 places. Number 1, when you're driving your car, because that's your auto insurance liability. Right? Number 2, when you're at work, because that would be your employer's general liability. I don't say workers' comp on that. Remember, liability covers other people. And under workers' comp as an employee, you're a first party under a workers' comp policy. But if you injure a customer, that customer is the third party. That's the liability exposure. So you got to watch out for that. So again, personal liability covers you anywhere in the world except when you're in your car and when you're at work. Now, the tricky part of that is Section 2 liability covers you anywhere in the world except, and instead of saying in your car, the exam says while you're driving your registered licensed vehicle on 10 acres of undeveloped land. And you're like, what the heck is that? Well, registered licensed vehicle means you're in your car. The undeveloped land, they just throw in there, that's useless information. Right? You're in your car. And so Section 2 liability does not cover you when you're in your car. Okay. Now, medical payments, this is for others. Now, where under auto, medical payments is for you and your family and your friends as passengers in your car. Liability medical is for others only. If you slip and fell in your own house, you cannot file a claim against your homeowner's policy. You cannot sue yourself for everything that you already own. Okay? So, but if you have a cocktail party and one of your friends slips and falls, your liability is going to protect them because they can sue you because they don't own your stuff yet. That's the liability in medical. Covers others. Right? Honestly, if you slip and fall, you should have health insurance for you and your family members. Okay? So medical to others is usually a smaller amount, maybe 1 to 5,000, and this is simply covering immediate first aid treatment and the ambulance ride. Okay? And then because of the injury, they're in the hospital, they're not able to work. That's the liability covering the medical bills and lost wages. That's how you want to understand these 2 coverages. All right. And it covers you anywhere in the world. That means if you go out to, out to Tahoe, you rent a cabin and you have a couple friends over, one of them's injured, this can actually cover it because it follows you and your family members anywhere in the world. All right. Again, except in your car and at work. And since it's liability, it also has supplementary payments built into it. Right? Legal defense costs. And so that's how you want to know it. So now taking a closer look, remember coverage A and B, the structures on the premises, that's real property. Right? Anything that's easily removable, that's personal property. So you got to know the difference there. So this would be real property. This is just personal property or sometimes called contents. Right? And you got to know the difference. Another thing is these 3 are also direct loss coverage. Direct physical loss, damage, or destruction to your property. That would be coverage A, B, and C. All right. Now, loss of use is indirect loss coverage. All right. Because your house burns down, you can't stay there. The insurance company now covers the cost to put you up at a hotel till we rebuild your house so you can move back in. So this is indirect, or it's called consequential loss coverage. In the commercial world, if a restaurant burns down, that would be the direct loss, right? The building burned down. The indirect loss is now they're closed. They're not able to sell food, cook food, sell it, and make an income. And so that would be business income loss, which is indirect or consequential. Okay, that's how you want to understand that. So make sure you understand these percentages also, very common on the test. Let's say we calculated through a reconstruction cost calculator that it costs $400,000 to rebuild your house. All right. So once you tell me this number, I already know how much these are valued at. All right. Because this is 10% of that 400,000. This is 50% of that 400,000. This is 20% of that 400,000. That means in the event of a total loss, your policy pays 400,000 to rebuild your house, plus 10% of that additional 40,000 to rebuild any other structures, plus another 50%, which is 200,000, replace all your belongings that you lost in the fire, plus 20%, up to 20%, which is 80,000 to cover the cost to put you up at a hotel till you can move back in after we rebuild your house. All right, so you're not just buying this amount, right? And this isn't, it's a percentage of that, but it's not part of that. It's above and beyond. So this plus this plus this plus this. So this is what, $720,000 that could be paid out if you had a total loss. Okay. So that's how that's calculated. So you do need to know these percentages. All right. Now, for liability, some other items, kind of rare, but just in case for the test, if you damaged someone else's property, like you borrowed your friend's camera and you took a trip to Europe and you dropped it, damage the property of others, will pay up to $500 for that camera. If you're part of a homeowners association, condominium association, or townhome association, the policy also has loss assessment coverage. So let's say they have a windstorm that rolls through that damages the roofs in this association area. And so we're going to use the association policy to re-roof, but that association policy has a high deductible. And so we're going to impose what's called a loss assessment. Everyone who lives in this area has to pitch in $1,000 per loss assessment. And that would be enough to cover the deductible to have our association policy cover the cost of re-roofing because of the windstorm. All right, so that's where that comes into play. I don't have it here, but in California, please understand, workers' comp is a mandatory endorsement in your homeowner's policies in California. In other states, it's typically optional, or it may be optional. But for in California, it is mandatory that if you bought a homeowner's policy, it includes workers' compensation. And that's if you have like a live-in maid or butler to help upkeep the property. Right? If you're going to contract someone to come out there and clean your house, they should have their own certificate of workers' compensation. But if you kind of hired someone to live with you to take care of the house, maybe take care of a family member, they could be covered under your workers' comp that's in your policy here. Okay. Dwelling coverage. Whenever you hear dwelling coverage for this test, or dwelling policy, I should say, think of you're a landlord. All right. So a homeowner, it's an owner occupied. You own it, you live in it. But a dwelling policy, you're a landlord. You own it and you just rent it out to other people. And so being that you own this building that you're having other people live in, you need coverage for the building. That's dwelling. You may have other structures. There could be a fence around the back side of the yard. Okay, maybe a shed. All right. Personal property, because you do have utilities there, maybe a washer, dryer, dishwasher, refrigerator. Okay. You might even rent it out furnished where you could cover that. Okay. If the place burns down, where your tenants are going to leave because they can't live there, it's untenable, a dwelling policy can cover lost rents, right? Because they can't live there. But you relied on that rent. Because honestly, if the place burned down, your tenants are going to go someplace else. They're not going to still pay rent in a place they can't live, right? But you relied on that rental income, and so coverage D is lost rents. Now, let's say it's a 3-unit structure where you lived in one unit, you rented out the other 2. And if the place burns down, where not only did your renters leave, but now you can't live there, that would be additional living expenses. Okay. To be honest with you, if I take coverage D, lost rents, and coverage E, additional living expenses, and if I bundle this up and put it on a homeowner's policy, that's exactly what your loss of use coverage is. So coverage D on a home is taking coverage D and E on a dwelling policy, bundling it, and just calling it loss of use. All right. Why dwelling has 5 parts and why homeowners only has 4, I don't know. I wasn't at that meeting. Okay. But one of the things you do need to know is coverage A, B, and C on a dwelling policy are the same as A, B, and C on a homeowner's policy. And to be honest with you, if I take D and E, it's the same as loss of use on a home policy. Okay, just for some reason they split it in two parts for a dwelling. All right. Dwelling is only property. The liability and theft coverage is optional. All right. You can add it in, right? This is your direct loss coverage. This is the indirect loss coverage or consequential loss. Always know that because of this loss, there's additional claim loss, and that's consequential loss. So getting into that math question, Steve, right? If the limits of liability on a structure are $75,000 and the structure is worth $125,000, how much would be owed on a fire loss of $50,000 if the policy has an 80% coinsurance requirement? And it does say disregard any deductibles. And let me clarify that. If you say the policy has a standard deductible, on all of your property policies, a standard deductible is $250. A business owner policy, the standard deductible is $500. Okay, and so those are the normal deductibles. Again, if you want to raise your deductible, you can lower your premium. Okay, but here it says disregard the deductible, or once in a while it'll say that there is a $1,000 deductible. Again, so read the question carefully. Okay, so you got to know the equation. It's what you did have, which is 75,000, divided by what you should have had, which is 80% of the value of the building. Don't put the value of the building as the bottom number on that fraction. Otherwise, you'll get it wrong. So you did have 75. You should have 80% of 125, which is 100,000. 75 divided by 100 simplifies to 3/4. 3/4 times a $50,000 loss equals the 37,500. So you need to know the equation. What you did have divided by what you should have. Simplify this. You multiply it by the loss. That's how much the company will pay on the claim minus any possible deductible. So again, in this case, you did have 75. You should have had 100, right? Remember, 80% coinsurance. So you should have had 80% of the value of the building, right? And so that's why we have 100. So 75 divided by 100 is 3/4 times the $50,000 loss equals 37,500. When you take the test, they do have a drop-down tab, which has a calculator, whether you're taking the test on site or taking it from home. There's a little calculator button to drop down. Don't use your own calculator. Don't bring your own calculator, okay, if you're going to the test site. All right, so, but again, 2 math questions, okay, no more than that. In California, it's 150 questions. You need 60%. You can miss 60 questions. As long as you get 90 correct, that's passing. That's a D by most standards. Okay, not an easy D. Don't let me mislead you. I can't say it's a piece of cake because then you won't study. But I don't know how to intimidate you thinking it's not passable or you overstudy. So you got to hit that blend. To just get that 60% to pass. 60% on this test is like an A++. Okay, unless you show somebody your score, nobody knows. You passed. So D gets you a license to have an unlimited income potential license. All right. So all right. Which of the following is a valid reason for an applicant to purchase an HO3 policy instead of a dwelling policy? The reason you would buy a homeowner's policy instead of a dwelling or landlord policy is because you want broader coverage. Homeowners is property, theft, and liability packaged up. Dwelling is only property. So you buy homeowners instead of dwelling because you want broader coverage. But the test might go the other route and say, why would you buy a dwelling policy instead of a homeowner's policy? And if you see it go the other way, it's because you don't live there. I remember dwelling is your landlord. So you own a house, you rent it out to other people, but you don't live there. That's the mindset the test has when it comes to dwelling policies. All right. Now, if you have primary coverages like our auto liability we talked about, you have homeowner's liability, then we can take a look at getting some additional lawsuit protection. And there's two categories. We have excess liability, which is additional liability or lawsuit protection over only one line of coverage. And we have an umbrella policy, which is additional liability over multiple lines of coverage. Right? So, I mean, anytime you see L for liability, you're protecting against lawsuits. Right? So another way of looking at this is excess liability is additional liability over one line. Like, let's say you don't own a car. Maybe you have some house parties and you have some guests and you want to protect yourself. And so you get a home policy. You don't have a car, so you don't need auto liability. You just need additional liability in case something happens when you're throwing a party. All right. And in umbrellas, if you have multiple lines, so you have a home, you have a car, maybe you have a boat, right? And you just want to put additional liability over all of those. And that's what an umbrella is: higher limits, broader coverage over underlying policies. And every once in a while, you might have a liability exposure that's not covered by an underlying policy. It can still be covered by the umbrella, but you're going to have to pay what's called a self-insured retention. Okay. So a self-insured retention is like a deductible for liability exposures that are not covered by an underlying policy, but can still be covered by the umbrella. And that's how you want to know that. Okay. Great. Can you get it? So simple. It is very simple. I don't know if you can take a screenshot. I mean, you can do that. I don't think I had this as a separate chart. I guess I should put that up there. So thanks for asking. Okay.
Professor, just one question.
Yeah. Yep.
Like, let's say for the personal umbrella policy, let's say I have a homeowner's policy. So
Yep.
like, do I buy that like as in another policy, or it's gonna be like, or just a separate policy that like, I don't
You
know.
mean home and umbrella?
Yeah,
They're
let's
separate
say,
policies. They're
I
separate
know
policies.
I know, but like, let's say it's for high ticket items, right? Or not high ticket,
Okay, wait a
for
minute, wait a minute, wait a minute. Okay, this is liability. So this is covering other people. This
yeah.
isn't a floater covering your high ticket item because you have jewelry. This is not what we're talking about. This is liability, which is you injure someone else, you damage someone else's property. Okay,
Okay.
does that make sense?
Yeah. But I
So
mean,
remember, property is your stuff. And if you want higher limits, then you can either raise the limits, increase value, or you can get a floater. Okay. Liability is for other people. Like let's say you have a cocktail party, or you have quite a bit of assets, and even if you get hit, if someone gets hit by a Tesla, all right. I mean, dollar signs pop up in their eyes, and they talk to an attorney and they want to sue you because they want to get as much as they can out of you. Because if you have a Tesla, they're thinking you've got money, right?
mm,
And so the umbrella would be additional liability to protect against that lawsuit.
so for the umbrella, it's gonna be like an additional coverage for
Yeah, it's a
okay.
separate policy, which is additional lawsuit protection. You got it.
Okay.
Okay, that makes sense.
Yes, thank you.
You got it. All right, Steve. I'll put this together and put it up there. You got it, man. All right. All right. So, what is a self-insured retention under an umbrella policy? And we just covered it. It's basically deductible. It's applicable to losses that are excluded by an underlying policy, but yet still can be covered by the umbrella. All right. And so let me go back here. That would be this. All right. So maybe you have a liability exposure that's not covered by one of these three primary policies. Your umbrella can still cover it if you pay a deductible or a self-insured retention. All right. Because it's a liability exposure. That's where that comes into play. All right. Moving over to the commercial side, let's go to a business owner policy. And for business owner, think of mom and pop general store, kind of like this. Just a simple store, nothing big. For BOPs, cannot be more than 6 stories high, cannot be more than 100,000 square feet. You cannot do more than 3 million a year in annual sales. Okay, so you're looking at mom and pop, flower shop, general store, coffee shop, sandwich shop. That's basically it for the test. Okay. So it's kind of like a homeowner's policy. You have section 1, which is property, covering your building and your contents at work, right? And section 2 covers liability. Maybe a slip and fall, or maybe someone bought one of your products, took it home and suffered an injury because of it. There's also medical payments. Remember, this is more of like the ambulance ride or immediate first aid treatment, right? And it's also supplementary payments because anytime there's liability, there's supplementary payments attached to it. Again, this is the hidden coverage that people don't realize exists for them. All right. Now, if the insurance company chooses to defend a claim against you, the insurance company chooses to. You don't tell them, hey, you need to defend this. No. It's the insurance company's option and choice to defend in a case against you. That's what this is about. And if they do, they pay the defense costs. Right? If it's larger than 6 stories, larger than 100,000 square feet, or you do more than 3 million a year, now we're going into the commercial world. Okay. So business owners is a commercial policy, but it's for small mom and pop business. When you hear commercial coverage, you're thinking the larger businesses. All right. And so the coverage is on the property side. You have your building and personal property coverage. Instead of theft coverage on the personal lines, it's called crime coverage for a business. Like Avon was saying, covering your high theft items under a personal property floater, personal article floater. For a business, it's inland marine coverage. Okay, so maybe you have some fine arts in your wall in your house. Well, I get some fine arts in the lobby of my company. So it's kind of the same thing, but for a business now. Boiler machinery, which a lot of times is called equipment breakdown coverage, is kind of like if you bought a house, they're going to offer you a home warranty. Now, with a home warranty, I mean, if your washer breaks down, you pay a deductible, someone comes out there to either fix it or replace it. Okay, well, boiler machinery is equivalent to a home warranty, but for a business. Right? Most of your premium for boiler machinery actually goes towards inspections to prevent loss. Right? Yeah, because I mean, if we do inspections, replace out a worn out fitting with a brand new one to keep from a loss occurring, that's very preventative, and that's kind of what this approach is. So most of your premium goes towards inspections to prevent loss. Business auto coverage. Now, for business auto, there's a couple areas here. Number one, you could be in the automobile related business, like you have a repair shop, or maybe you have a dealership. But you could also be a company that has a company car that you furnish your employees. And so that would be the commercial auto coverage or sometimes business auto coverage. There's physical damage for the vehicles, right? Like collision, other than collision, right? Or they call comprehensive for commercial. But there's also liability. Now, there's the part of the liability for autos would be the same liability you have with your car. You have bodily injury, property damage, you have medical payments. But if you're driving customers' vehicles, so a couple of things, like if it's a repair shop where you're taking customers' cars on a test drive and there's a collision claim, that's garage keepers coverage specifically covering that. Another area is maybe you have a parking structure, a parking lot where you drive customers' cars, like valet parking. Garage keepers coverage is the only coverage that'll actually cover a collision claim while driving the customer's vehicle. All right. And so I want to emphasize that. And that's part of the commercial auto coverages. All right. For the rest of the business, we have general liability, commercial general liability, general liability. Okay. And this covers, again, premises and operations, right? Maybe there's a slip and fall, or maybe they bought something, they took it home and it malfunctioned and injured someone later on. So there's different sublines or separate aggregate limits, which we kind of talked about earlier. Okay, that's how that comes in. So that's the liability portion. All right. So a bulldozer, an insured is using to level a property for a customer, overturns, causing fuel to leak and pollute the ground. Where would this pollution loss be covered? Now, sometimes you're kind of thinking pollution. Where's pollution covered? That's not the question. You're using it to level property for a customer. So the customer is the third party. And if you damage someone else's property, that's liability. So it's not professional liability. The difference between general liability covers the business. Auto liability covers the vehicles associated with the business. Professional liability covers the individual. So like a hospital would have commercial general liability in case there's a slip and fall in the hospital. But the doctor would have professional liability, like malpractice, in case that particular doctor made a mistake in the care and treatment. Okay, so this covers the business. this covers the individual. Malpractice is a specific type of professional liability. When you get up and running with your license, you should have errors and omissions, which covers in case you make a mistake while transacting insurance. Maybe someone said, I want to add this coverage, and you got sidetracked and forgot to add it, and lo and behold, a loss occurred. And they said they wanted it added, and you didn't. So it was a mistake you made. That's the errors and omissions coverage. Okay. So a person with a commercial policy is burning leaves. The fire gets out of control, causing smoke damage to a neighboring property. So the loss is covered by, again, it's a neighboring property. So you damage someone else's property, that's going to be liability. If you burn leaves and you were damaging your own property, that's not going to be covered, right? Because you can't damage your own property and collect. Okay, that's borderline fraud. In some cases, actually would be fraud. Right? And you hear stories about that in the automobile claims world. Okay. And so this is that second question. It looks like the previous question. A person with a commercial policy is burning leaves. The fire gets out of control, causing smoke damage to their own property. The loss is covered by, and it's not. You damage your own property. Okay. Along with catastrophic exposures like earthquake, flood, war, nuclear risk, those are excluded. Intentional acts and wear and tear are also excluded by your policies. All right. So again, this is kind of could be viewed as intentional act. You might not have meant to, but it's still damaging your own property, typically not covered. That's like leaving a window open before a rainstorm where the rain gets in and it damages your carpet and your sofa or whatever that's right by that window. That's not going to be covered because that's negligence. Okay. And negligence may be excluded on some of the policies. All right. So remember we had an umbrella policy on the personal line side. Well, guess what? We have umbrella in the commercial world also. Additional liability over one or more liability coverages, right? So for business, you might have general liability. You might have vehicles, so you need auto liability. Under Part 2 of your workers' comp policy, you have employer's liability. That covers losses that fall out of the workers' compensation world, okay, where you could get sued by your employees. And if it's not covered by an underlying policy, just like on the personal lines, you could pay a self-insured retention if it's a liability exposure, and your commercial umbrella could cover the loss. The self-insured retention on a personal umbrella is typically like $250. In the commercial world, the self-insured retention is like $10,000. So it's like a deductible that you have to pay before the umbrella kicks in if you don't have an underlying policy. So your underlying policies pay $1 of any claim, but if you exhaust these limits, then you can dip into your commercial umbrella limits. But if it's a liability exposure and you don't have an underlying policy, well, then you've got to pay something before the umbrella can kick in. And that's how you want to view that. All right. All right. So with that, I mean, a little over an hour, but that's all good. Any questions?
Professor, I have a couple of questions, but if you, I want to know about the other guy, Steve, if he wants to go first.
No problem. All right, Steve, any other questions? You're muted there. I don't know if you wanted to pitch anything out. So, no questions. All right. All right, Even, throw it out there, man.
Okay, Professor, just for so can I change the topic here, or is that okay?
Yeah, as long as it's associated with the test, yeah.
Okay.
It's all good.
uh, okay. On the playbook, there's this like a vocab. It's enjoin and restarting order.
Say that again.
It's enjoin and
Oh,
restarting
enjoin and restrain.
restrain
Okay.
order. Yeah, yeah.
Okay. So what's happening here is if you are licensed and you do something wrong in the insurance industry, the insurance commissioner or director of insurance or superintendent of insurance, depending on the state you're in,
Okay.
may basically say, hey, we caught you doing something wrong. These are the fines and penalties we're going to pay. And then we're going to also give you a cease and desist order, which is a written slap on the hand that says, don't ever do this again. Okay. Now,
Oh,
that's if you're in the industry. Now, let's say we have someone who's not licensed. And for some apparent reason, they went in your office, they took a bunch of applications that were sitting around, and they went out to the public and they sold them on a cash and carry basis. So, since they're not licensed, they're really not under the commissioner's jurisdiction. And so, the insurance commissioner will knock on the door of his brother, the attorney general, or sister, depending on the state. And the attorney general could issue an enjoin and restraining order saying, stop doing what you're doing, you're creating fraud. Okay. So if it's
oh,
within the insurance industry, it's a cease and desist order. If it's outside of the insurance industry, it's an enjoin and restraining order.
okay.
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 In a nutshell, that's how it is, how it works.
Okay. And Professor Four, okay, so you have this other one. It's uh, modular and package policy. Like,
Yeah.
okay. So I had the definition. Like I wrote it down. I just want to understand it like more. So
All right. So these are coverage parts or modules. Okay.
okay.
So all the test did is instead of saying, commercial coverage part, they called it commercial coverage module. So module and parts is the same thing. And so these are parts of a policy: property, crime, in the marine, boiler machinery, commercial auto, general liability, or they're sometimes called modules. Now, if you only bought one, like if you're, let's say you're in the automobile industry, then you bought one, a monoline auto policy. All right, so that would be one monoline policy or coverage part. If you bought two or more, like property and liability, two or more is a package or modular policy. Okay.
Oh,
So
okay,
all it
okay.
is, all they did was go and do a thesaurus and change the word, all right, with a synonym. Okay.
Okay.
That's all it is.
Okay. And okay, Professor, do you have this other one? It's uh, let me see, where is it? Okay, it's accidental discharge of water.
Don't read too much into that. In
Oh,
order for a loss to be covered, especially water loss, the kind of for the test, the key way of understanding it is the loss must be sudden and accidental. That means you have to be able to put a specific date and time to when that loss occurred. Okay. So if you have a slow leak within your walls, that's dripping and causing dry rot, mildew, and mold,
okay.
that's probably not going to be covered because it was not sudden and accidental like a ruptured pipe.
Oh, so like basically, we need a date, like date in, right?
Yeah, that's in a sense, that's how you want to know it. Okay. In the real world, you get into some other stuff where they find extensions where it could be covered in some cases. Okay. So people have this misnomer that insurance companies try and deny claims so they save money. And it's actually wrong. If you talk to some claims people, they're actually a lot of times they try and find ways to pay a claim because you paid all this premium for coverage. I mean, what can we do to find these extensions where it could be covered? And there's some really good claims people out there that work with that.
Yes, yeah, you're right. And okay, Professor, for okay, and under homeowners policy, building or
Building or ordinance.
ordinance, yeah.
Mhm.
So like just like I said, I have the definition. I just want to like understand it, like so maybe like maybe on the test, I just want to know like um, what is the best definition for it?
You got it. So keep it simple. All right. Let's say you bought a house and it was built in the 1970s.
Okay,
And in the 1970s, they didn't put sprinklers in. Okay. And because now with everything that's going on, a high fire line, the heat, now what they changed the building ordinance or building codes or building laws to where if you build a house, it has to include sprinklers. Not only in a brand new home, but if you had a loss and you had to rebuild the house, you now have to put sprinklers in. Well, since your house was built in the 70s and didn't include sprinklers, when we rebuild your house after a fire, we're not going to give you free sprinklers. Okay. And so the building ordinance excludes the additional cost of construction to put sprinklers in your house. Because again, you didn't have them before the fire. Why are we giving you some free sprinklers after the fire? That's a gain, and that's not what insurance is about. And so there, you'll see the building ordinance or law exclusion, but you'll also see the building or ordinance law endorsement, where you can, for a slightly higher premium, purchase this building or ordinance coverage that actually could cover the increased cost to rebuild your house so that it meets the current building codes. Okay.
So basically it covers extra like uh, like not coverage but extra stuff.
Increased cost because of building code changes.
Building cover. Okay.
Yeah. Building ordinance or building code changes.
Okay.
Otherwise, you'd have to pay for the sprinklers out of pocket.
Yes, because just like you have on the other um, it's like where you like when you're doing something and extra stuff like come up, it's not covered
Mhm.
by insurance, you know.
It may not be. Yeah, you got it.
Mm,
What else you got?
oh, it's okay. I think the other guy. I don't know. Should I go or
If you got another one, bring it on. I'm Steve. Steve will jump in anytime.
okay? Okay. So, Professor, for the monoline policy, is it like for umbrellas?
Umbrella is not a, well, no, umbrella is multiple lines. Remember, higher limits, broader coverage over multiple lines. Excess liability is over one line.
So, like excess liability is going to be monoline.
Mm, that's not how you want to know it. Okay. Excess liability is additional liability over one line of coverage, but you don't call it a monoline. A monoline would be just property coverage, like a landlord policy. Okay, let me go back here. A landlord policy, a dwelling policy, is only property. There's no theft, there's no liability, there's no auto. It's just property. That's what you call a monoline policy. Okay. A
Uh,
homeowner's is a package because it covers property, covers theft. Actually, I don't have that here, but also covers liability. So there's different lines of coverage. And so when you hear lines of coverage, that means types of insurance. Okay. So property is one line or type, liability is one line or type. Okay.
okay.
And so a homeowner's is a package policy, whereas a dwelling policy is a monoline policy, a single line of coverage, basically property.
Oh, okay.
Okay. Yeah. And so for commercial, if you, like I said, if you only bought auto insurance, it's a monoline. But again, if you bought property, crime, and liability, then that would be a package, or like I said, modular, which is multiple parts or multiple lines.
Oh,
Okay.
okay.
All right. You'll get it. Through repetition, you'll pick it up. And just keep going through the questions, keep going through the playbook. And if you do have additional, quick hits, reach out, give me a holler. If not, maybe you want to learn a little bit more about the commercial general liability program. Then at the bottom of the page, when you log into my website, again, I have recordings of webinars to teach you specifically that part to give you a better understanding.
Yeah, yeah, yeah. Okay.
Okay. All right. Any other questions, sir?
I think I'm good. Thursday,
All
I'm gonna
right.
do the test.
You'll be fine. Over the weekend, reach out if you have any questions. I'm going to be roaming around up around Vacaville and UC Davis area. So,
Oh, okay.
but yeah, so I'll be on the road. So give me a call if you or text me and I'll call you and we can chat. Not a problem. Okay.
All right.
You got it.
All right.
Awesome. Awesome. So for those of you that are watching this, if you haven't registered, consider it. Go to lgdstudy.com. Just use a PayPal link next to the course that you're looking for. You don't need to have PayPal. You can use any credit debit card. When you register, you will get a reply email with your login instructions and information to help you study and how to best use my site. I typically take people out of their comfort zone in how they study. My questions, I don't want you testing yourself. And so my questions, I have the question with the answer already highlighted because I want you to make the association that when you see this question, this is the answer you want to associate with that question. Because if you test yourself, if you pick a wrong answer, you just imprint it in your brain, this is the answer for this question. And even though you graded at the end of the test, when you go see that question again, you're going to pick that same wrong answer because in your mind you were right. And so that's why I kind of push away from testing yourself. Get the concepts down. When you see this question, associate it with this answer and vice versa. All right, because sometimes a question will flip where the answer is now the question and the question is now the answer. So there's a method to the madness, but it works, folks. Be open, be coachable. And it starts here with being open and coachable because you're jumping into a whole new possible career path. And it's totally new to you. So be open, be coachable, be a sponge, and listen to people who are teaching you the processes to help you succeed. So with that, thank you, thank you, thank you. You guys, thanks for joining me tonight. Good luck on your studies. Again, as you study, do not hesitate to reach out. All right.
All right.
All
Thank
right.
you
Have
very
a great night. You guys take care. Good luck on your exams.
much. Thank you.